Hi, it's Anthony here. Just like to say before I get into the video, this is the real me. It's not an AI generated avatar or anything like that. Okay. I've done some research and put together this presentation, calling it the Great Divergence 2026. Let's get into it. For the better part of a generation, the entire global financial world moved to the beat of a single drum. But what happens when the band breaks up? What happens when every musician starts playing their own chaotic tune? Today, we're diving into what's being called the Great Divergence of 2026. So think back with me to the world after 2008. The playbook was pretty simple, right? A crisis hits and boom. All the big central banks, like the US Federal Reserve and the European Central Bank, they all ease policy together. And then when inflation went crazy after the pandemic, they all tightened up together. Okay, so it created this synchronized, predictable tide that basically lifted or lowered all financial votes at the same time. Well, that era of predictability is officially over. I mean, gone. The lockstep march of the world's central banks has completely fallen apart. And that harmony has been replaced by, frankly, a mess of competing interests. We are in a totally new environment now. And that right there is the core question we're tackling. What does this new world economic chaos actually look like? What are the real consequences for the markets, for your money, and for the whole global economy or the whole global order? When every nation is suddenly forced to solve its own unique problems all by itself, this huge structural shift has a name, the Great Divergence. So let's break down what that really truly means. Just look at the language on this slide. It's so definitive. This isn't some temporary blip on a minor disagreement. The material that I researched on this is crystal clear. The foundational idea of a coordinated global monetary policy is, and I'm quoting here, unequivocally over. And this slide just illustrates that change perfectly. We are literally moving from that old world of synchronization and these nice, gentle global tides to a new world that's defined by divergence and what we could essentially call violent cross currents. So who are the main characters in this whole new drama? Well, let's meet the world's most powerful financial institutions, okay, which are now finding themselves with dangerously conflicting goals. This is really a story of central banks at war. This table just lays out the whole conflict perfectly. You have to remember, for years, these banks were all on the same team, fighting a common enemy. First, the global financial crisis, then the pandemic, but now that common enemy is gone and each one is fighting a completely different battle. You've got the US Fed cutting rates because they're worried about jobs. At exactly the same time, the Bank of Japan is hiking rates to stop its currency, the yen, from completely collapsing. And the European Central Bank, well, they're just frozen, trapped by stagflation, terrified that any move they make, whether it's cutting or hiking, could be a total disaster. So you have these three giants all pulling in opposite directions. Now, the Bank of Japan's decision to raise rates has resurrected one of the most feared trades in all of finance, the widowmaker. It's a historically dangerous bet of shorting Japanese government bonds for decades. It just destroyed fortunes, the widowmaker. The logic behind it is simple. If Japan's interest rates rise, how on earth can it possibly afford the payments on its mountain of debt? And here's why that trade is so terrifying. Japan's national debt is a staggering 300% of its entire economic output. 300%. So when interest rates were at zero, this was kind of manageable. But now Every tiny little rate hike pushes the government closer and closer to the edge of insolvency. The Bank of Japan is, well, they're playing with fire. And here's the thing. This isn't just Japan's problem. For years, investors have been using what's called the yen carry trade, okay, which is basically borrowing yen for free, pretty much, to go speculate on everything from stocks to crypto. And as Japan raises rates, that free lunch is over. So investors are forced to sell those global assets to pay back their loans, which creates selling pressure and markets that seem completely unrelated to what's happening in Tokyo. And it's not just the central banks creating all this chaos. There's a massive political and fiscal storm brewing, and it's centered right in the United States. Just take a look at this number, $1 trillion. That's how much cash the US Treasury is expected to suck out of the financial system in just the first quarter of 2026 alone. This is a liquidity drain of historic proportions. So how does this even happen? Well, it's a process called the Treasury General Account, or TGA refill. The easiest way to think about it is like a giant financial siphon. After all the political fighting over the budget, the Treasury's main bank account gets really low. So to refill it, they issue a flood of new bonds. And when banks and investors buy these bonds, that cash gets pulled out of the private market and locked away at the Treasury. The result is what we could refer to as a liquidity air pocket. All of a sudden, the fuel from the market rallies just disappears. This creates a massive headwind for assets like stocks and crypto. And here's the kicker. It's completely independent of what the Federal Reserve is doing. It's a fiscal problem that can easily just steamroll monetary policy. So in this new chaotic world, who wins and who loses? The market isn't just one single thing anymore. This divergence is creating a really sharp split between different types of assets. Let's start with the big one, AI. The 5 largest tech companies are projected to spend an unbelievable $450 billion on AI infrastructure in 2026. That's more than the entire GDP of many countries, all betting on an AI-powered future. But here's the critical question for 2026. After all that spending, where's the money? The market narrative is shifting from a story about amazing potential to a demand for actual results. This is the year AI has to prove it can actually generate real revenue, moving from just a valuation story to an execution story. Now, while tech is facing its show me the money moment, let's look at the forecast for hard assets like gold. We're seeing some incredibly bullish targets from the major banks. And you have to ask why? Well, because in a world of divergence in fiscal payoffs, global central banks themselves are losing faith in government bonds and are diversifying into gold as a hedge. And now for the complete contrast, while a monetary asset like gold is soaring on fears of instability, industrial commodities like oil are facing a much, much different reality. The forecast here is for a glut of supply and slowing global demand, pushing prices down. So this is the divergence in action. The very same chaos that benefits gold is also a sign of economic weakness that hurts oil. Even commodities aren't moving together anymore. So we've got warring central banks, political chaos, and splintering markets. The final question is, how do you navigate this new reality? What's the playbook? So I think the key takeaway from this research that I've done is pretty clear. First, you have to respect the divergence. The differences between countries are now the main driver of markets. Second, watch the liquidity. Fiscal decisions like that TGA refill can matter more than the Feds. And third, hard assets are back as a crucial hedge. And finally, selection is everything. The days of just buying any stock and watching it go up are finished. Okay, the simple, synchronized world of easy buying, or easy money, I should say, is gone. It's been replaced by a much more complex and a much more dangerous environment. one that rewards you for paying close attention and frankly punishes anyone who assumes the old rules still apply. Which leaves us with one last thought to chew on. In a world where all the traditional relationships are breaking down and central banks are at odds with each other, is the only true safe haven an asset like gold or bonds? Or is it simply being aware of the violent new currents that are shaping our world? So, plenty of food for thought there. If you have any ideas on this, I'd love to hear from you. Definitely comment below. A thumbs up would be greatly appreciated. That would help the channel. And of course, subscribe and hit the bell if you'd like to be notified of more videos. I'll be posting regular videos like this on economics and financial shifts that are taking place that impact all of us. With that, stay safe, and I'll see you in the next one.